Hello, and a very warm welcome to this Investors Chronicle Future of Private Investing session. My name is Dave Baxter. I'm the funds editor at the IC. And in this particular session, we're going to be discussing all things exchange traded funds. And we're specifically going to ask whether they still represent the affordable way to high returns. You don't need me to tell you that ETFs and other forms of passive exposure have become a core element of many investor portfolios. The reasons for that are, I think, pretty self-explanatory. They provide us with an affordable, straightforward, and importantly, often very nicely diversified exposure to stock markets and bond markets. You could also argue that ETFs have passed some important tests in recent history. What's interesting, I find, is they actually proved pretty resilient in the violent COVID-19 sell-off that we witnessed in February and March 2020. Perhaps that's managed to dispel some concerns about liquidity that have often been bandied around in discussions about ETFs. Having said that, we now face a new and arguably bigger test. As we've discussed today, we are in times of great economic uncertainty. And once again, unfortunately, we are seeing huge levels of unpredictability and market volatility. So against this quite grim and challenging backdrop, do ETFs still provide stability, or should you be branching out into different approaches? Should you instead be favoring active funds, or should you be going another route and picking your own direct investments? We're going to be trying to tackle those questions and also looking at the kind of criteria you might use if you are going to buy an ETF. So some big issues to tackle, but fortunately I have a couple of great guests to help me do so. Firstly, I'm very pleased to say we have Deborah Furr, a very distinguished ETF specialist and founder of Women in ETFs EMEA. We also have Eamon Prendergast. He is Director of Palantir Financial Planning, and he has long and I think very useful experience of dealing with different investments and financial products. So we should get a range of different useful insights into these particular debates. So first, let's get some housekeeping out of the way before we get started. Most importantly, I'd really love for you to get involved and put any questions you do have to myself and the guests. So please do make full use of the Q&A function on the right-hand side if you do have any questions in mind. Beyond that, it's worth noting that this session will be available on demand for 30 days, just a few hours after it's finished, and you'll be able to access that using the same link that you're using today. Finally, there are some useful links, resources, and a feedback form above. So that's the housekeeping done. Without further ado, I think it is time to get into some of these big discussion points. So Eamon and Deborah, both of you, thank you very much for joining us today. Whenever we get into big moments of volatility, uncertainty, we do see the perhaps, it's a bit overdone, but perhaps kind of active passive debate rears its head again. And I suppose now you do, perhaps Deborah, I'll start with you here. You do have to ask, if markets are kind of changing, if we're seeing a new regime, we're seeing things rotate, and markets are generally getting much more topsy-turvy and unpredictable. What would be your kind of key case that people should be staying the course with ETFs, or would you agree with those criticisms?
Well, so thank you for having me today. It's a pleasure to be here. I would say for most investors, it's really hard to time the market. So for most people, if they have a well-established asset allocation in place, they should stay calm and carry on, because I think to change your allocation, then hope to get in at a better time, you end up paying commission getting out, commission getting in, market timing moves, etc. So it's very difficult for, I think, many people to be able to do that, even professional investors. So I think kind of staying calm. I think the reality, though, is when you think about ETFs, the ETF is a wrapper. So it's basically a mutual fund with the added benefit of being listed and traded on exchange. So inside of ETFs, you can have active strategies. Most of them have been indexed, but there are some, and a lot more in the US, where you see active strategies being provided within the ETF wrapper. I think what you realize with ETFs is you can try to get alpha through your selection of individual securities or through buying active mutual funds or through hedge funds. And that's challenging because we know on average, if you look at the US, last year, 82% of active funds did not beat the S&P 500 as their benchmark. So on average, 7 out of 10 active funds do not beat their benchmark in any given year. And if you go out 3 and 5 years, consistently doing it is very challenging. And every year, for some reason, we will hear this is the year for active. And unfortunately, we haven't seen that significant shift that in any given year that I've been following the markets, all of a sudden active is the winner and index isn't. So what people have realized is you can generate alpha through low cost index exposure for tactical asset allocation. And so asset allocation will deliver about 90% of the variations in returns. And I think increasingly people have found they believe they can generate alpha through some funds or security selection, and they do that. But on the other side, they're using low cost index products like ETFs to generate the alpha through asset allocation.
Yes, I mean, it's always interesting to point about allocation and that being seen to drive your returns rather than wonderful stock selection or fund selection. Eamon, I wanted to bring you in on this then, on the kind of allocation front. I mean, I imagine you deal with many different portfolios of different ilks and perhaps different goals, but do you have kind of strong views on perhaps the best kind of building blocks to use, the best allocation approaches to take? I mean, I suppose one interesting thing is that if you believe you're a kind of globally oriented investor, and particularly if you're using some of these global passive products, then you are still really making a big play on the US. I mean, would you personally, when you're dealing with clients and things, would you kind of look to try and diversify beyond that to a great extent, or what's your take then?
Well, thanks for having me on. I have to echo pretty much what Deborah was saying. So we're going to be in agreement on quite a few things here. But I would say the ETF side, it's the new kid on the block, right? So if you look back on the ETF, probably started around about 1990 in Canada. And then it sort of moved into the US, and the UK, then it came across. Vanguard opened their first ETF in 2001. So we haven't got a huge sort of back data, but we've got enough there to look at. So we can look at the crash in 2007, 2008, where people said that active fund managers should actually outperform at that stage because they're looking at inefficiencies. And when there's inefficiencies, that's when you're supposed to actually create alpha, as Deborah rightly said. And that alpha needs to take place normally when there's the most amount of volatility or there's sort of inefficiencies in the marketplace. So I think there's two things there. The sort of expansion of the ETFs is huge now. So where it was a minnow, even 10, 15 years ago, if you look now between even active and passive, so it doesn't just include ETFs, but also includes index funds as well. Last month was the first time that passive funds have actually overtaken active funds in terms of total wealth within them. So, and that's in 30 years, pretty much. Obviously, the active funds the index funds are already there. And there's been a lot more pressure now on charges. And that's come from the UK as well, from the FCA. So they're looking at what advisors charging, what platforms are charging. And what the ETFs has done is actually drive down prices, not just on the ETF, but also on the active fund managers. So if you look at some of the unit trusts and investment trusts, they've had to reduce their charges now because they're in competition. Although they don't like to think they are, they're actually in competition now, and they've got to add some value somewhere. And when you look at your total charges, if I've got a client that they're paying 0.2%, they're paying an advisory charge, maybe a platform charge, if that's at 0.7 and an active fund is already charging 1.5%, you can see what that's going to do to the returns to the client. And a lot more studies have actually been done on the returns to the client over an extended period of time. So if they're holding a pension for 30 or 40, 50 years, and they're paying 30, 40% more over that period of time, that's going to erode their pension massively. So I think for some of my clients, if we look at it, we tend to sometimes use a satellite approach. And that may mean that 90% may be in passive and they may dabble then in the other 10%. But also as well, you can go kind of short on the ETF side, as Deborah knows. You can get sort of inverse ETFs, right? So if you want to invest into the commodity market and you can see, well, actually, it's going gangbusters, I'll go long of ETF, but I can also do an inverse ETF as well. So although you can't go liquid, as they classic, go into cash, you can do the opposite. So you can actually short sell in effect as well.
You'd have to be very careful with those products, though, don't you? Because they're
well,
very
you
volatile.
Well, you do, but then they're not a future an option, right? So you can only lose the money you actually put into it. So they can be, but even the sort of leveraged ETFs, that they can obviously be more volatile, and obviously you're getting an increase as well as a decrease possibly. And then you've obviously got ETFs which are both physical and synthetic as well. And there's been lots of arguments in and around the synthetic side to say, well, actually, they are very high risk. But when you look under the bonnet, the ETFs and the counterparties they use a whole array of counterparties. So that actually reduces the risk sometimes on the synthetic side. And they can only, I think the maximum is 10% as well on the ETF side that they can use as a counterparty. And normally in terms of collateral, they may use anything from 90 all the way up to 120% as well. So I think the argument that's coming in, mainly from the active guys, there's a lot of rebuttals that can be made from the passive side.
I mean, it's interesting you mention, things like kind of synthetically and physically backed assets and that kind of thing, which perhaps leads us into, I mentioned earlier, it's good to cover off, say you are convinced, I mean, you guys clearly are very convinced by the continuation of passive doing its job perhaps over a decent period of time. But if you do want to kind of go into ETFs as an investor, and maybe I'll put this to you, Deborah, what kind of key criteria would you look at? I mean, I suppose a lot of the mainstream stuff you should assume is going to be pretty low cost, but what else would you look for beyond that?
Well, I think you have to first think about what exposure do you want. So I'll take an example like gold. So if you want exposure to gold, do you want exposure to physical gold bars? Would you like exposure to futures that provide exposure to gold? Or do you want exposure to gold mining companies? So I think it's really important to understand what type of exposure are you looking for. Once you identify that, then you want to look at what are the available products. And, if it is gold mining companies, then you want to look at, well, is it gold mining companies that are in developed markets, in emerging markets, in one country? You want to look at the benchmark so you understand what the methodology is. And probably then people want to look at the fees. A lot of people get focused on fees. And so you want to look at that annual cost. And you want to look at potentially what stocks are inside of it. But understanding the product is really important. And I would say that the products that are synthetic are not very many any longer. It used to be that many banks were offering ETFs. As the banks reorganized, they moved their ETF business from being in the banks to being in asset management. And so most of the ETF issuers have primarily put all their products into physical when possible. But there are cases where if you wanted broad commodities, you're not going to have an ETF that's a warehouse with oranges and pigs and whatever, like all just sitting there, I don't know, doing what, fermenting. So clearly synthetic exposure does make sense in some places, and you can get benefits from synthetic. It allows you to get potentially more diversified exposure to, say, a broad aggregate fixed income benchmark, or it can give better dividend treatments for underlying securities. But in general, I would say understand what exposure you want, understand the benchmark, understand what's inside of the ETF, and then look at the fees and look at the assets. I think those are, and for some people, they want to know the brand behind it. So clearly in Europe, currently we have 91 issuers of products. We have nearly 3,000 products, and they're listed on 29 exchanges. So you have 11,000 listings of those ETFs. So you want to look at which listing you're going to buy, because many ETFs will be listed, say, on the London Stock Exchange, but also on many other exchanges across Europe. So what currency do you want to buy it in? So think there's a number of things to look at, but it is pretty simple once you start creating a framework and you understand what you're looking for.
How important would you judge size to be? Because sometimes that's one of the metrics people look at to see whether an ETF might be more liquid, and therefore you're going to incur kind of fewer costs in buying and selling.
So that's a good point. So I think size is definitely important for large investors, because if I'm an insurance company or pension fund, the amount I invest in a fund or an ETF can't be more than 10 or 20% of the asset. So if an ETF or mutual fund only has $5 million or pounds, I can't put very much into it. As a retail investor, that's less important. And it's important to realize that liquidity for ETFs, you can think about them as having secondary liquidity, just like buying any share, buying Vodafone. But then for large trades, and large would be more than 20% of the average daily volume, there are brokers who are allowed to do what's called create or redeem. So the firm that you would be trading with would, if it's a large order, contact one of the authorized participants, and they would go buy the underlying portfolio of securities. So if it's a FTSE 100 ETF, they would buy that list of securities, typically in units of 50,000. That basket gets sent to the custodian, and the ETF gets bigger. So real liquidity in ETFs comes from the underlying basket of securities. And then you also have secondary liquidity, just like any share. So ETFs in reality are more liquid than many other things out there, because you have two ways that you can get exposure. And you have these brokers who are ready to support the product all the time during the trading day. And they're required to by the London Stock Exchange.
Yes, yeah. And as I mentioned earlier, you did have that quite interesting test of, the liquidity bogeyman that people always point to in 2020. And generally, you had some interesting developments in the bond space, but generally ETFs seem to kind of pass that test. I wanted to turn then to, we've had a few kind of interesting viewer questions. Some I believe we've kind of inadvertently answered already. For example, that partly the case on whether you stick with trackers or try and be a bit more nimble. But one really good question that's come through, and perhaps I'll turn this to you, Eamon, and then move it across to you, Deborah, is which sectors and asset classes of ETFs do you currently believe to be most exciting for innovation and increased investor diversification and exposure in the next 2 to 5+ years? So I guess simply, what's exciting you? What are you seeing in the ETF space that you were thinking, that's an interesting thing to get into?
Well, first, I think it depends on the client as well, which I think Deborah already alluded to. But we have to really go back and look at their attitude to risk, and that's so important, right? When you're actually choosing any investment, so your attitude to risk, and also your capacity for loss. So for most of my clients, we've got a fairly balanced portfolio in terms of ETFs. So we buy a number of different ETFs, although we have to be careful that we're not concentrating in one particular area, and that can be a problem with any investment when you start buying a number of investments, and then when you look under the bonnet, you're actually concentrating in quite a specific area, and then when either the index goes up or down, you realize that you are mapping that exactly, obviously, as you would do with the ETF, but where you think you've got a hedge, you haven't actually got a hedge as well. So I think in terms of the most sort of exciting areas, for me, I'm still very much equity focused with most of my clients. I think that's where you kind of get the best returns. And also when you get areas of high volatility, what you tend to find is that there tends to be a correlation which converge. And what I mean by that, bonds and equities are supposed to move in opposite directions most of the time. If we look what's happened over the last sort of 3 or 4 months, that hasn't happened. Equities have gone down and also bonds have gone down. And then you also need to look at why the bonds have gone down. And it tends to be the more long-dated bonds, which have got longer durations and tend to be more volatile. So I think where people are, if you try to hedge their bets in terms of putting equities and bonds together, some of those portfolios, which actually should be seen as less risky, have actually had less returns. But I think the ESG space could be an interesting one going forward. It's still relatively new on the ETF side, but I think that's expanding, and more people I think will get involved in that side of it. There's always arguments about greenwashing, etc., but I think you would get that with any fund at the moment, and it's still relatively new. It had a great 2 or 3 years, and now, like most investments or most sort of investments at this moment in time, things have sort of been hit, and the ESG side is obviously getting hit as well.
Yeah, it's an interesting point. And Deborah, what would you kind of add to that? What's exciting you the most at the minute?
Yeah, so I think the way Eamon started off saying people have to think about their risk profile and tolerance for drawdowns, et cetera, is really important. Like, what are they saving for? I do think that we've seen a lot of innovation around disruptive technology. So thematic ETFs, if someone's looking to look out into the future in areas where there is massive change expecting to be happening. So, you think about autonomous cars, you think about changes in healthcare around demographics. There's a lot of ETFs now that allow you to play narrow slices. And also sometimes it even morphs into ESG. So if you think about solar and you think that's going to become important, I think one of the things we do benefit from in Europe is we have well, at least in broader Europe, we have the SFDR classification. So ETFs and mutual funds in Europe have been classified as being Article 6, 8, or 9. They don't really like us to say this, but you can think of it as being light green to dark green. And there are some real innovations happening around carbon credits and other exposures that are very new, and ETFs will make it easy to invest. I think for other investors who are looking more globally, we really do see the rise of China, the rise of India, and ETFs make it very easy for investors to get exposure without having to gain foreign investor status, open special brokerage accounts, worry about FX and other things. You can buy an ETF here that allows you to gain exposure to mainland Chinese equities or bonds or to India. So I think if you do have that appetite for risk, you have that outward looking view that there are political changes afoot and economies are growing at different rates, I think ETFs just make it easy to invest in those ways. So I think those are some of the, I think, interesting things that are happening.
It's interesting you mentioned China and in general, the way that you can now have more and more idiosyncratic approaches via ETFs. Because you remind me that, for example, people have been worried about China in the last year or so, given the regulatory crackdown, and now you've seen a little flourish of launches of kind of ex-China emerging market funds, and you can almost get any kind of flavor of very niche exposure you want now. But I suppose you do need to understand just how niche that is, and it becomes maybe more of a kind of binary trade on something a bit riskier. I was going to turn to something completely different that a viewer has raised, which is very important to go into in a practical sense. And someone simply asked, what is the difference between an ETF and an index fund? Which I think is something we often assume people will be aware of. But yeah, I don't know if one of you wants to kind of jump in and just briefly go through what the key differences are there.
Happy to do it, but even if you want to kick off, happy for you to do it.
No, okay, Deborah, no, far away.
Very polite.
At the heart of it, there are a lot of similarities, but the key difference is how an investor would gain access. So to an ETF, you need to have a brokerage account or an advisor who's going to buy it on your behalf. But assuming you're doing it yourself, you need to have a brokerage account where you would put in an order to buy, just like buying a share. And if you're selling, you put in an order to sell. So you're going to pay probably some form of commission when you buy or sell. The annual cost with ETFs typically is lower. When you're buying an index fund, you're buying it from the firm that is managing the fund. And when you give them money, they're going and buying securities so that the fund gets bigger. So with index funds and mutual funds in general, the money goes to the portfolio manager. They have to buy some more shares to invest that cash. And when you want to take your money out, they would be selling some securities to give your cash. So it's happening with the firm and the PM on the case of an index fund or mutual fund, and it's happening you putting orders to a brokerage firm trading on exchange with an ETF. I think those are probably the most significant differences that I can think of.
Yeah. I was just going to add probably a couple of things. Maybe sometimes platforms do charge differently on funds versus shares, and because ETFs have shares, that can be important. And also ETFs can be, I mean, we've warned against market timing, but they can be a quicker way of putting that money to work if you were trying to be very nimble. Well, very interesting. But I'm afraid that's all we have time for this particular session. But if you have more appetite for ETFs, there is very relevant discussion coming up next. For the next session, Deborah, Eamon and I will be joined by two further specialists to discuss what you can get out of ETFs versus investment trusts if you're weighing up those different active and passive options. And we will be going into some things we've touched on already, like ESG and thematics and some other hot areas like income. Just to remind you of those housekeeping points, useful links can be found above. This session will be available on demand within a few hours. And please also do fill out the feedback form if you can. That's really useful for helping us to shape our future events. So thank you very much to my guests for all their input, and thank you for watching.
Thank you.